On Thursday, January 29th, 2026, Microsoft lost $357 billion in a single day. That's not a typo. $357 billion gone. The same day, gold hit the highest price in human history, then crashed 12% in 18 hours. Silver lost decades of gains in under an hour. The dollar fell 3% against major currencies in 48 hours. And if you think that sounds like a normal market correction, you haven't been paying attention to history. Because what just happened wasn't random. It wasn't even surprising. It was predictable. Inevitable, actually. It's a pattern, one that's repeated itself across every major empire that's ever controlled the global reserve currency. Rome, Weimar Germany, the British Empire, and now the United States. There are 4 stages to this pattern. Stage 1, trust. Stage 2, debasement. Stage 3, crisis. Stage 4, collapse. We just entered stage 3, and once stage 3 starts, it doesn't stop, it only accelerates. Let me show you something. The national debt of the United States is $38.43 trillion. That number increased by $2.25 trillion in the last year alone. Do the math. That's $8 billion per day, every single day, including today. Interest on that debt hit $1.2 trillion in 2025. We now pay more in interest than we spend on Medicare, more than we spend on national defense. Read that again slowly. We're borrowing money to pay the interest on the money we already borrowed. And here's the part nobody wants to say out loud. The math doesn't work. It can't work. It won't work. This isn't political. This isn't left versus right. This is arithmetic, and arithmetic doesn't negotiate. Let me walk you through the pattern, because once you see it, you can't unsee it. Stage 1 is trust, real trust, earned through actual productivity, military dominance, sound money. The currency works because it represents genuine value. Everyone wants it. Everyone needs it. Trade flows through it. This stage can last centuries. Stage 2 is where things get interesting. The empire realizes something dangerous. They control the money everyone uses, so they start creating more of it, not to produce more value, just to fund things they can't afford. Wars, social programs, political promises. The gap between what they collect in taxes and what they spend becomes permanent, so they fill it with currency creation, debasement, inflation. And here's the trick. Because they control the reserve currency, they export the consequences. Other nations absorb the excess money supply. The inflation gets delayed, pushed into the future. Stage 2 feels like prosperity, feels like winning. It's actually the beginning of the end. Stage 3 is the awakening. The math becomes impossible to ignore. The debt can't be paid, not difficult to pay, mathematically impossible. The currency starts losing purchasing power despite interventions. Foreign nations start questioning whether they want to hold reserves in a currency being systematically destroyed. Confidence cracks, not all at once, in waves. A bank here, a central bank statement there, then suddenly, violently, usually triggered by something that seems unrelated. Stage 4 is the reset. The system breaks. The currency either hyperinflates or gets replaced entirely. Reserve status shifts to a new power or new system. Wealth transfers from those holding old denominator assets to those positioned in the new reality. This stage is brutal, fast, irreversible.
Let me prove this to you. Ancient Rome, 2nd century AD. The denarius was the dollar of the ancient world. Every trade route, every merchant, every transaction of consequence was denominated in Roman silver. The coin contained 95 to 98% pure silver under Augustus, 4 grams of actual precious metal. Trust was absolute because the value was real. For 2 centuries, the system worked. That's stage 1. Then came the expenses, massive military spending, soldiers demanding higher pay, emperors needing funds immediately. Tax revenue wasn't keeping up, so they made a choice. They started debasing the denarius. Nero was first, 64 AD, reduced silver content to 90%. Still high, still trusted, but the precedent was set. By Marcus Aurelius, it dropped to 75%. By Caracalla, 50%. The government was creating money by destroying its value. And for decades, it worked. Stage 2 looked like strength. Then came the crisis of the 3rd century, 235 to 284 AD, 50 years of collapse. By the reign of Claudius II in 269, the denarius contained 2% silver. 2%! From 98% to 2% in 200 years. Prices exploded. A measure of wheat that cost 1 denarius in the year 200 cost over 200 by 270. Foreign territories stopped accepting Roman currency. Trade networks broke down. The military couldn't be reliably paid. 26 emperors in 50 years, most assassinated. That's stage 3. Stage 4 came slowly, then suddenly. The denarius disappeared from circulation. People hoarded older coins with higher silver content. Bad money drove out good money. By the 4th century, the Western Roman Empire abandoned the denarius entirely. The currency that had unified an empire for 400 years was gone. Wealth held in denarii evaporated. Wealth held in land, in productive estates, in tangible assets survived. Different time, different continent, same pattern. Weimar Germany, 1920. After World War I, Germany faced catastrophic reparations. They couldn't pay through taxation, politically suicidal, economically impossible. So they printed. The numbers tell the story. 1921, 60 German marks to 1 US dollar. January 1922, 191 marks to the dollar. July 1922, 493 marks. November 1922, 7,000 marks. August 1923, 1 million marks. November 1923, 4.2 trillion marks to the dollar. In 18 months, the currency became worthless. Workers demanded to be paid twice per day because money lost half its value by afternoon. People carried wheelbarrows of cash to buy bread. A lifetime of savings couldn't purchase a week's groceries. The middle class was annihilated. But here's what's critical. Wealth didn't disappear, it transferred. Those who owned land saw property values skyrocket. Those who owned foreign currency multiplied their purchasing power. Those who owned businesses and tangible goods survived and prospered. The pattern repeated. One more example, because this isn't ancient history. The British Empire, 1815 to 1971. For over a century, the British pound sterling was the global reserve currency. The sun never set on British territories. Sterling was backed by gold. That's stage 1. Then came 2 world wars, massive military spending, expanding social welfare, the National Health Service, pensions, housing programs. Government spending exploded while the industrial base declined. But they kept spending. They were Britain, the empire. They could afford it. Stage 3 crystallized in September 1949. Britain was forced to devalue the pound by 30% overnight. Not a choice, a crisis. By 1967, another devaluation, 14%. The pound that had been worth $4.86 in 1939 was worth $2.40 by 1967. Stage 4 arrived quietly but completely. Nixon closed the gold window. The Bretton Woods system collapsed. The dollar replaced sterling as the undisputed global reserve. By the 1970s, Britain faced stagflation, inflation above 20%, unemployment rising, industrial collapse. The IMF had to bail them out in 1976, an empire reduced to a charity case. Wealth held in sterling lost 70 to 80% of its purchasing power over 3 decades.
3 examples. 3 empires. Same 4 stages, same outcome. Now, let's talk about what happened this week, because every single characteristic of Stage 3 is present right now. The United States established reserve currency status at Bretton Woods in 1944. We had half the world's gold, half the world's manufacturing. Absolute military dominance. Stage 1 lasted decades. Stage 2 accelerated after 1971. Once the gold backing disappeared, the temptation became irresistible. Federal debt in 1971 was $370 billion. Today, it's $38.43 trillion, a 100-fold increase in 54 years. We've added more debt in the last 15 years than in the previous 224 years of American history combined. The Federal Reserve did exactly what the Reichsbank did, what Rome did. They created money out of thin air. Quantitative easing, zero interest rates, emergency lending facilities. And it worked for decades because we controlled the reserve currency. Other nations absorbed our inflation, bought our debt, enabled our spending. The consequences got exported, delayed. Stage 2 felt like American exceptionalism. It was actually American currency debasement. But something changed this week. Let me walk you through it, day by day. Wednesday, January 28th, the Federal Reserve holds its first policy meeting of the year. Markets expect rate cuts. Instead, they pause. No cuts, cite persistent inflation. And here's where it gets interesting. The Trump administration publicly pressures the Fed for rate cuts, launches an investigation into Fed Chair Jerome Powell, questions Fed independence. By close, yields spike. 10-year treasuries jump to 4.3%. Something shifts. Thursday, January 29th. This is when the crack becomes visible. Asian markets open down 6 to 9%. Tokyo, Hong Kong, Singapore, all deep red. Because Asian markets understand something. If the Fed is losing independence, if political pressure is mounting, if inflation isn't actually controlled, then every dollar-denominated asset is at risk. European markets follow. A major financial institution announces it's unwinding $35 billion in U.S. Treasury positions. Not because of default risk, because of confidence risk. This is unprecedented. A major European bank publicly questioning U.S. fiscal sustainability. When U.S. markets open, futures are limit down. Circuit breakers trigger. Microsoft announces cloud growth concerns. Stock drops 10%. $357 billion gone. But that's just a headline. The real story is gold. The metal hits $5,680 per ounce, highest price in human history, up 30% for the month. This isn't speculation. This is flight to safety, flight from currency to hard assets. Then the margin calls start. The CME Group raises margin requirements on precious metals. Leveraged traders can't meet requirements. Forced liquidation begins. Silver plunges double digits in under an hour. Gold crashes 12% from its peak. But here's what's critical. This wasn't fundamentals changing. This was leverage unwinding. The underlying driver, the loss of confidence in currency, that didn't change. It intensified. Friday, January 30th. The liquidation spreads. Crypto markets dump. Bitcoin falls below $80,000. Why? Because leveraged traders are selling everything liquid to cover margin calls. The dollar falls 3% in 48 hours. That's not normal volatility for a reserve currency. That's loss of confidence. Let me show you why this fits Stage 3 perfectly. Characteristic 1. Sudden loss of confidence in sovereign debt. Check. European institution publicly questions U.S. Treasury holdings. China dumps $120 billion in 1 month. Characteristic 2. Currency instability despite intervention. The Fed issued emergency statements Wednesday and Thursday, promised stability, promised liquidity. The dollar still fell 3%. That's intervention failure. That's loss of control. Characteristic 3. Foreign holders reducing reserve positions. Check. China's holdings reduction is the largest single-month drop on record. Characteristic 4. Asset prices disconnecting from fundamentals. Microsoft's business didn't change. Amazon's operations didn't collapse, but they all crashed double digits because this isn't about company value, it's about currency confidence. Characteristic 5. Political paralysis preventing solution. Congress is deadlocked on debt ceiling negotiations. Again, the political system is incapable of addressing structural problems. Characteristic 6. Mainstream narrative of temporary disruption. Every financial news network called this a correction, a healthy pullback, a buying opportunity. Exactly what they said in 1929, exactly what they said in 2008. The denial is part of the pattern. But here's what's different this time. Institutional credibility is gone. In 1929, people still trusted institutions to fix it. Roosevelt, the New Deal, faith remained. In 2008, people believed Bernanke and Paulson would stabilize the system. That's not true anymore. Public trust in the Federal Reserve is at multi-decade lows. Congress approval is single digits. 23% of Americans now own cryptocurrency, specifically as a hedge against dollar debasement. That was 2% 10 years ago. The institutional credibility that allowed previous Stage 3 moments to be papered over doesn't exist anymore, which means Stage 4 could arrive faster, more violently, with less warning than any historical example. Now let me destroy the 3 objections, the 3 reasons people think this time is different.
Objection 1. We have technology, AI, innovation. We'll grow our way out of this. Here's the problem. Technology doesn't change mathematics. Germany in the 1920s had the most advanced industrial technology in the world, didn't stop hyperinflation. Britain in the 1960s pioneered computing and nuclear power, didn't stop imperial decline. Japan in the 1980s had technological superiority in electronics and robotics, didn't prevent 30 years of stagnation after their debt bubble burst. Technology creates productivity, but it doesn't eliminate the consequences of creating currency faster than value. The math always wins. Objection 2. The dollar is too big to fail. It's 70% of global foreign exchange reserves. They can't afford to let it collapse. That's exactly what they said about the Roman denarius, too integrated to fail. It failed. That's what they said about sterling. The empire covers a quarter of the Earth's surface, too big to fail. It failed. Size doesn't prevent collapse. Size determines how catastrophic the collapse is when confidence breaks. And we just watched confidence crack in 48 hours. Objection 3. American exceptionalism. We are the United States, strongest military, most dynamic economy. We're not Rome. We're not Weimar. We're not Britain. Every empire thought they were exceptional. Every single one. Rome thought they were eternal, built monuments to permanence. Britain thought they ruled by divine right. They were all certain they had advantages that made them immune to historical patterns. They were all wrong. Exceptionalism is a story we tell ourselves. The math doesn't care about stories. So let's talk about what Stage 4 actually means, because this is where people get confused. Stage 4 doesn't mean apocalypse. It doesn't mean society collapses into Mad Max chaos. It means the financial system resets. The currency either hyperinflates or gets replaced. Reserve status shifts, and wealth transfers massively, permanently. In Rome, wealth held in debased denarii disappeared, but wealth held in land survived. In Weimar, cash holders were annihilated, but real estate owners prospered. Foreign currency holders multiplied wealth. In Britain, sterling holders lost purchasing power for 50 years, but those who moved to dollars, to American equities, to hard assets, built generational wealth. The pattern is consistent. Wealth doesn't disappear in transitions. It moves from those who don't understand the pattern to those who do.
Let me paint two scenarios. Same person, same starting wealth, different positioning. Scenario A, typical American, 60% of net worth in their home, mortgaged, 30% in a 401k, mostly U.S. stocks and bonds, 10% in savings. They believe in the trust institutions, think this is just market volatility. When Stage 4 hits, their savings lose 70 to 80% of purchasing power. Their 401k crashes 40 to 60% in real terms. Their home provides little actual wealth protection. They've just lost decades of accumulated wealth in months. Not because they were reckless, because they didn't understand the pattern. Scenario B, same person, same starting point, but they studied his 40% in hard assets, gold, silver, commodity, 30% in productive real estate and international equity, 20% in productive businesses, 10% in cash across multiple currencies. When Stage 4 hits, their hard assets multiply in nominal terms. Their real estate maintains real value. Their productive businesses keep generating income. They don't just survive, they potentially multiply wealth while others are devastated. Same person, different understanding, completely different outcome. Here's what happens next. Short term, next few weeks, expect extreme volatility. Markets will swing 5 to 10% daily. Central banks will announce emergency measures. Politicians will promise solutions. None of it will address the structural problem, because the structural problem is mathematical. $38.43 trillion in debt, growing $8 billion per day, while GDP grows maybe 2 to 3% annually. The math doesn't work. Medium term, next 3 to 6 months, watch for 3 specific signals. Signal 1, foreign reserve holders accelerating dollar sales. If China, Japan, and Saudi Arabia start unwinding positions aggressively, that confirms Stage 3 acceleration. Signal 2, the Federal Reserve losing control of the yield curve. If long-term rates spike despite intervention, that's the bond market rejecting Fed authority. Signal 3, gold sustaining above $5,000 per ounce. If it stabilizes despite intervention, that's permanent capital flight from currency to hard assets. If you see all three signals, stage 4 is imminent. Long-term, 1 to 3 years, expect a monetary system reset. Might be a new digital currency, might be a return to commodity backing, might be a multipolar reserve system with regional currencies. The specific structure is less important than the outcome. The dollar's exclusive reserve status ends, and when it does, wealth transfers from dollar-denominated assets to whatever replaces it. Let me end with absolute clarity. The pattern doesn't care about fairness. It doesn't care who worked hard or saved responsibly or played by the rules. Currency collapses destroy the savings of prudent people and the pensions of honest workers. That's not right. It's not fair. But it's history. What happened this week, January 28th to January 31st, 2026, wasn't the event. It was the signal, the warning, the visible crack in stage 3 that shows us exactly where this is headed. Microsoft's $357 billion loss, gold's historic spike and crash, the Fed's loss of control, foreign institutions questioning U.S. debt, the dollar's fall, China's record treasury sales. These aren't disconnected events. They're symptoms, manifestations, proof points of a pattern that's played out across millennia. $70 billion didn't just evaporate from markets this week. It transferred. Some into hard assets, some into foreign currencies perceived as more stable, some into the accounts of those who understood what was happening and positioned accordingly. The next transfer will be bigger, much bigger, because stage 4 resets entire systems. When the dollar loses reserve status or experiences significant devaluation, trillions will transfer, the largest wealth transfer in human history, from those holding old denominator assets to those positioned in the new reality. The pattern is here. The math is clear. The signals are visible. Rome's denarius from 98% silver to 2%? Check it. Weimar's exchange rate from 191 marks per dollar to 4.2 trillion? Verify it. Britain's pound devaluation from $4.86 to $2.40? Research it. U.S. national debt at $38.43 trillion, growing $8 billion per day? Interest costs at $1.2 trillion? It's all documented, all verifiable. All real. So, here's the only question that matters. If we're in stage 3 and every historical example shows stage 4 is inevitable, are you positioned for what's coming? Because ready or not, whether you believe it or not, the pattern doesn't wait, it doesn't pause, it doesn't reverse, it only accelerates.